Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. With this video, I'm really going to cover two things. Well, with the article, I've covered two things. With the video, I'll be looking specifically at Target, the brick-and-mortar retailer, big box store. And I'm going to start by just looking at the company's business here. And that's what the orange line on this graph is, a plotting of Target's earnings going back to calendar year 2000. The white line is the dividend growth. You can see this company is a dividend champion and aristocrat. It's raised its dividend every year, although I want you to notice the dividend's flattened out a little bit in recent years. The company's business is definitely a growth stock, averaging about 8.6% growth over this time frame. However, there are bouts of cyclicality, which is kind of normal for retailers. At least a lot of retailers will go through periods where their earnings ebb and tide a little bit. Now, when I add stock price into the graph, I'm really going to start bringing in the importance of valuation, because back in the irrational exuberant period, Target was trading at very high PE ratios, 25, 30 times earnings. And that persisted with an occasional reversion to the mean where it got back down to a 15 PE ratio-ish where it belongs. And then, of course, the Great Recession, like most stocks, the company's stock price fell, but so did their earnings a little bit. But I do want you to notice the company did raise its dividend. And then price tracked earnings pretty well after that. We had periods where it got overvalued and periods where it got undervalued. But there's something about valuation that I want to really focus on here. Now, the other thing I was talking about that I didn't fail to mention when I started this video is it's whether brick and mortar is alive or dead, or whether it's a dying industry and it's all going to go the way of the Amazons of the world. Well, I don't think so. I think brick and mortar still has its place. As I point out in the article, the vast majority of business still is based on brick and mortar, but Target is kind of a moderately priced to low priced retailer. And the key is when you invest in a stock, you have to pay attention to the valuation you're paying. As Warren Buffett once said, price is what you pay, value is what you get. So I'm going to shorten this time frame down to a period starting with 2004. And the reason I chose this time frame is twofold. Number one is I want you to notice that Target was trading approximately at fair value at the beginning here, and it's currently trading at approximately fair value at the end. Now, the point I'm trying to make here is if you invest in a stock when it's fairly valued, you position yourself to essentially enjoy the results of the business operations that the company achieves on its shareholders' behalf. If you invest at high valuations, you can earn a lot less than what the company actually achieves as a business. But here we've got a business that has had an average growth rate of 7.2% over this time frame, and that includes some numbers here for estimates. But regardless, if I go into the performance report here, I'm going to look at two aspects of performance. The price going from point A, $28.21, up to point B, which is yesterday's close of $85.49. That's my growth component. So when I look at that growth component where the stock went from the 28.21 to the 85.49 gave me a 7% rate of return. I want to be real clear about this. This is totally consistent with the growth rate that the business achieved as an operating company. In other words, how fast its earnings actually grew. However, the light green shaded area here depicts dividends after they've been paid out to the shareholder. So you get the growth from point A to point B, but then you also get the benefit of all this dividend income. And the area below this white line is the dividend payout ratio. So when I look at performance from the aspect of dividends, I see that a $10,000 investment in Target on January 31st, 2003 would have generated over $7,000 in dividends compared to about 52 or almost 5,300 in the S&P. Growth was slightly less than the S&P, but there was really a dead heat when it came to the total return. But the point is a couple of fold. One is for the dividend growth investor, this is a much better, clearly dividend growth stock, and it's about comparable on a total return basis. It's a slightly above average company with an above average dividend yield. Target currently offers a 3% current dividend yield. The company's A-rated, has less than 50% debt on the balance sheet, and again is a little bit cyclical. Now I want to make another point. I think Target is fairly valued today. I think it was undervalued at the beginning of this year, and the stock is up almost 30% just since the beginning of 2019 or the end of 2018. So the stock has done, grown by 29.4%. That's an 88% annualized, but that's because we're only into half the year here, and not even half the year yet. But the bottom line is we've had this great performance, a reversion to the mean as the stock came from being undervalued back to fully valued. But I want you to notice something else when you're looking at these price actions relative to the company's performance. I want you to notice once again how often the stock price reverts to this 15 mean. When it gets above that PE, it drops. When it gets below it, it rises back up, and so on and so forth. So now I'm going to go into forecasting a little bit, because as I also pointed out in the article, I believe in having as precise as I can, or a very high expectation of what my rate of return potential before I invest in a stock might be. I do that by running what-if scenarios. So here I'm looking at the consensus of 23 analysts that are following the stock for next year's fiscal year end. We expect earnings of $5.95. Those same analysts expect $6.35. That's growth of 10.4% for this year and 6.72. By the way, I want you to notice the company has a January 31st fiscal year, so it's not a calendar fiscal year. But if I just use the calculator function, that would give me just under a 10% total rate of return by year end this year. If I go out to year end next year, it's about 9.67% or 66%. Which means I got a chance to make over 9% a year here. Now, if Target were to trade at its normal multiple, which is a little above 15, that number could actually hit double digits. So I have now an expectation of a rate of return between, let's say, 10 and 15% going forward. If I look at the expected 3 to 5 year growth, it's about 7.1%. And this is getting a little further out than I like to go, but I still have an opportunity to make over 9% a year. So what I'm really suggesting here, ladies and gentlemen, is I'm looking at a stock with a real clear expectation of what I might be able to earn on the company. And when I review Target once again, I'll add the normal PE back here so that you see that higher number I showed earlier. It's a range. These are valuation reference lines, and they represent a range. I consider Target fairly valued today. It's not overvalued. It's not undervalued. It's, moderately fully valued. So it's a good sound investment. I liked it a lot better, at the beginning of the year than I do now. I want to make that clear. But I also want to close this video by making a couple other points about valuation. This is adjusted operating or, reported earnings as some companies talk. I can also look at several other earnings metrics, but when I'm looking at dividend growth stocks, companies that offer me high yield and above average market yield, I always turn to operating cash flow. Now, I have a very specific reason for that. First of all, it's a great way to value a dividend stock. If you value Target based on its operating cash flow, the company trades at about 8.5 times cash flow. That's the blue line on this graph. But what's really important about this graph, I don't even care about valuing the stock using cash flow. I do. What I really care about is how well is the dividend covered. And you can see the company's generating, multiples of its, in other words, cash flows are multiple of its dividend payments. So this company is covering their dividend, like a blanket, as the old expression goes. Now, in the same vein, I also like to turn to free cash flow, because free cash flow is the cash flow that's left over after what the company spent to run its business. Now, Target is doing a lot of remodeling and they've been spending money, so their free cash flow has been covering their dividend pretty nicely since coming out of the recession. There were periods of time back in 2000 and 2001 when they didn't. But if I'm looking at this stock more recently or during what the Amazon thread is, I've got free cash flow that's adequately covering the dividend. So the point I'm getting at is when I look at this company from a standpoint of other metrics in addition to earnings, I'm going to take a look here next at EBITDA. And I'm going to go ahead and add price to EBITDA, because this is another way that I like to value stocks. It's kind of funny because Warren Buffett once quipped that EBITDA was earnings before all the bad stuff. Of course, we all know it's earnings before interest, taxes, depreciation, and amortization. I was reluctant to even give this metric to FastGraph subscribers for a long time, but I eventually decided to play around with it because a lot of people were really telling me, how great EBITDA was as a valuation reference. So I added it to the FastGraphs, and lo and behold, it turns out to be a very excellent valuation reference. Now, I want to make something clear about what I'm saying here, and I'll end the video with this. The key here is that I've got a back test here. I can look at price to EBITDA, and I've got a normal price to EBITDA of about 6.3. That's what this orange line is. It's 6 times EBITDA. All right, and I can clearly analyze this by looking at Target and say, that there have been many times when the company has traded at a price to EBITDA above that. There's also been many times where it's traded at an EBITDA below it. So I would call this, not necessarily optimum would be when you could buy the stock when it's trading below its normal price to EBITDA. It's currently slightly above that, so that gives me another indication that the stock is not a great bargain today, but I think considering the quality of the company, it's reasonably priced. Anyway, this has been Chuck Carnevale saying thanks for watching. If you like what you see here, don't forget to hit the subscribe button below. I consider Target a high-quality dividend growth stock with an above-average dividend yield that can be purchased at a sound valuation today. It's not overly cheap, but I do think you do okay if you own Target for the long run, and if it ever did get cheaper in the future, you could always add more. Anyway, thanks for watching.